Now, having looked at the reasons for low correlation, we need now to move on and look at inflation and diversification right over here. That is our next component and our next focus, like that. So, inflation and diversification. Inflation and diversification. Now, inflation or money, the purchasing power of money becomes eroded as inflation increases. So for commodities, as we have just seen over here, we are saying that inflation commodities would be a good inflation hedge because they are uncorrelated, lowly correlated, or negatively correlated to the prices of stocks and bonds, or to the values of stocks and bonds. So including commodities in the portfolio would tend to reduce the component of diversification. If you allow me to come on this other side right here, what I'm saying is this. Is that when you include other asset classes, each investment has got a component of non-diversifiable risk. In it like that, the risk that cannot be diversified. So we are saying that this graph, this is number of investments, moves like that. This is the risk. So the more if you invest this in stocks, so for example, if you add both alternate investments, if you probably add commodities and the like that, you probably add other asset classes like that, the exposure of the portfolio towards risk will tend to reduce. Look at this side over here. We are looking at the risk component. As you add additional asset classes that are uncorrelated with stocks and bonds, then you're saying that the component of risk will reduce. It was initially there when you invested in one asset class, but because you're adding additional asset classes, it will tend to reduce from that component to that component, or to that value right there. So the overall value of the portfolio tends to be protected, and inflation does a good job towards that. So we can come over here and say the following. That inflation risk is the uncertainty of economic results caused by potential changes in the value potential changes in the value of a commodity, of a currency. I can say of a currency, not of a commodity. That is inflation risk. So we continue and say asset prices reflect expected inflation. Inflation rates. So commodities tend to provide protection in two specific ways. So that's what we need to identify. Commodities provide protection in two ways. Put a semicolon like that. The first way, we can say commodities are positively correlated. correlated with inflation, correlated with inflation. So that means the moment you include commodities in a portfolio of asset classes, then it will tend to reduce the component of risk like that. And we are looking at this side over here with how much we are concentrating on the risk component or exposures towards risk. Notice we're talking about inflation risk like that. So when you include commodities in a portfolio, since you are saying that they are positively correlated with inflation, what happens is that including commodities will tend to reduce your exposure towards the risk, the inflation risk component like that. So that is what we're saying. It provides protection. The second way is that commodity prices represent value of consumption. So we are saying that it is probably is to a great extent based on the forces of demand and supply. We are dealing with physical commodities, for example, wheat, barley, like that. It is expected that they are going to be consumed in future, and hence we are saying that commodity prices represent value for consumption. How much am I paying so that I can be able to purchase maybe say a given commodity like that? So we are saying that inflation. This subtopic of inflation diversification, asset prices being reflected, rather asset prices we are saying that reflect expected inflation rates. What are we expecting the inflation rates to be in future? So we are saying that commodity prices being a representation of values of consumption would be useful, especially when you try to seek exposure towards commodities with the intention of trying to reduce exposures towards risk, particularly inflation risk there. Now, having looked at that, we can now move on and look at something else. We can look at commodity futures, commodity investing without futures. There are three principal components. We are saying there is physical commodities, there is commodity-related equity investments, and there is exchange-traded funds. This is a particularly interesting area because we do not have this kind of investing in commodities. We don't even have a commodities market. Yes, okay, we may have a commodities market, and in the form of East Africa Tea Trade Association. That association deals with physical commodities, but they don't practice this commodity investing. It is pretty complex and for our market over here, but it is hoped that we can be able to have this kind of commodity investing methods there. So we say commodity investing, investing without futures. Without futures. So we are not going to use any form of derivatives for commodity investing. What we are going to do, we just want to physically purchase the commodity. If it's barley, if it's wheat, if it's copper, if it's gold like that, we can be able to seek exposure to commodities without the use of futures by, number one, physical, we've written over here, physical commodities. Number one, physical commodities. So what you do is that you just go ahead and purchase a physical commodity, wherever it is actually being mined, if it's being grown, you just go and buy the physical commodity, and you'll be able to have exposure towards commodities. The second way of how you can be able to seek or perform commodity investing is, we have written it over there, commodity equity investments. Commodity related equity investments. Commodity related equity investments. Now, this commodity equity investments is that you can be able to get exposure towards the equities. Yeah, you can, if for example, this is a company, or the best way to explain it is on this other side right here. We're saying that this is a company right here, X. It deals with the extraction. This is probably maybe, say, the land that we are saying, or the rocky areas like that. It goes and extracts. It extracts the gold from where it is actually from the gold mines there. Once it extracts gold from the gold mines like that, how investors can seek exposure towards commodities is by investing in the shares of this company. Investing in the shares of this company will mean what? That if this company has floated shares on the exchange like this, investors over here, this is the exchange, that investors can come over here and consider and seek exposure towards the exchange. And now the shares have actually been floated like this to investors. So investors over here, including institutional investors, can be able to buy the shares of this company that has listed the shares on the exchange. And by extension, investors can be able to seek exposure towards commodities. So buying the shares of a company that directly deals with extraction of the commodity, or buying the shares of a company that deals in, say, the growing of crops, or maybe growing of wheat, barley, like that, then provides exposure towards investing in commodities like that. That is the way how you can be. You have not used any form of derivative instrument there. You're just using equity investments so that you can be able to seek exposure. If the prices of gold increases, the prices of the shares of this company also increases like that by extension. The third way, right over here, come on this side. Third way, number 3, we are saying exchange traded funds. It's actually right over here. This is the third way of how you can be able to seek exposure like that. This is exchange traded funds, ETFs. Exchange traded funds. Now we are saying under exchange traded funds is where an exchange can come up with a fund here that concentrates on commodities. So investors can decide to invest in that fund. So these are dealing with commodities. It could be dealing with wheat, it could be dealing with copper, it could also be dealing with maybe barley and hops and something like that. So if you invest in that fund, then you somewhat indirectly seek exposure towards commodities. So those are the 3 ways how investors can seek exposure towards commodities. Very interesting, and we should be able to also have this kind of exchange or this kind of methods. We should be able to have a commodities market here in Kenya. Since we are agricultural based in Kenya, we should, or particularly maybe in the larger Africa, we should be able to have an exchange that deals with commodities.